Morning students, welcome back to the session on ICAI. Today we continue our discussion on ICAI 102, which is about share-based payment. We discussed certain concepts in the standard which were related to the share-based payment arrangements. We were talking about various types of share-based payment arrangements and the ways for settlement. In the last session, we discussed about two ways of settlement. One was through equity and second was through cash. Now, depending on the way it is settled, accounting varies, as we discussed. In case of equity settled share-based payment transaction, company will have to create equity. Whereas in case of cash settled share-based payment transaction, the company will be required to create a financial liability because there is an obligation to pay cash. So that's how this accounting changes. Now, similar to what we have discussed in terms of way of settlement mechanism, there is another way of settlement which is called as share-based payment transactions with cash alternatives. So we can say it's a mix of first two settlement mechanisms, or where there is an option which sort of mixes these two options. So now what we will do is we'll move on to this one and we'll try to understand the accounting requirement over here. But as we discussed, that the concept for settlement, which we have discussed in case of equity settled or cash settled, will also be applied over here. So it's not going to be a new concept, it's the same concept which will be applied over here. And that is something we have to consider while doing accounting if we get to see this type of settlement mechanism. Okay. So let's move on to page number 5.45. Those who are referring to the study material. Page number 5.45. Every time I start the session, I'm not sure as to why audio is a problem. So Ram has confirmed. I'm just hoping that the audio is fine now. Yes, Rishi, all okay? Now, what is this third mechanism? Third mechanism says that either the company or the counterparty. You remember we discussed about two parties, company and the counterparty or the other party. Now, in this settlement mechanism, either of them will have a choice. They will have the option. Means this company as well as the other party will have an option to settle in cash or equity. So they will have an option that they can settle in cash or equity. That is again an option available, and this is available to both of them. Yeah. So basically, both the parties have an option available. Now, in this case, what is it that is required to be considered? We need to understand as to which party will get the option and how the settlement is actually expected to happen. Accordingly, we need to then see whether it will convert into equity or a financial liability. So let's understand this with the help of a couple of examples. Moving on to example number 22. An entity issues stock options to its employees, which can be claimed either in cash or equity instrument of an entity. Yes, two options are available. So entity has issued stock option to its employees. So let's suppose other parties employees. Fine. And cash or equity alternative is available. Employees need to be in service for next 3 years. So what's the condition? condition is to stay in employment for 2 years. Entity needs to find fair value component of equity to be settled and fair value of cash to be settled. Each balance sheet date, these values need to be uploaded. Upon exercising of the option, if it is equity, then fair value liability will be transferred to the equity. Now, in this case, when we are talking about stock option, employee has got a couple of options. Either the employee can ask for cash or equity. Correct? So employee can either ask for cash after 2 years or equity. Now, as regards the company, who is an issuer? Now I'm again taking you to the principles of financial instruments. Company over here is an issuer. If the employee comes up with a demand of cash after 2 years, can the employee avoid payment of cash? No. Similarly, there's also a possibility that the employee demands for equity rather than cash. Now, as far as this company is concerned, or even say issuer is concerned, company over here is an issuer. What would this instrument become? Compound financial instrument. Why? Because there are two components which are attached to this instrument. Definitely cash is involved, but component of equity also exists. Now, what is the component of equity? What is the component of cash? We don't know. That is something which we need to get into when we go on to the measurement mechanism. But as far as its recognition is concerned, if we have to look at it from the company's perspective, what would it become? Compound financial instrument. Okay. So the way company will have to record this will be compound financial instrument. Next, moving on to next example. An entity buys some equipment from a supplier and provides an option to the supplier to either take cash or equity instrument equivalent to the value of the share price of that. So that's why it's a share-based payment arrangement. Why? Because it's linked to the share price of that. The entity is getting goods from the supplier, but the settlement is through cash or equity, and which is linked to the share price of the company. The entity will first find out fair value of goods received, then the fair value of cash settlement will be valued. The difference of fair value of goods received and the fair value of cash settlement option will be treated as fair value equity component. Now let's try to understand once again what is it that we need to consider by measuring the amount of liability for it. And here again, we are not discussing anything new, but I need to just, and in fact, what we need to consider at every point of time is that there is no new concept that we have been discussing. Compound financial instrument, all of you know, because we have covered financial instrument. Similarly, when it comes to compound financial instrument, we know it involves two components from the issuer's perspective. One is financial liability and second is equity. Correct? There is something which we know again. Now, how do we measure compound financial instrument? Standard says that whenever there is a compound financial instrument, we need to always measure financial liability. This is measured first. So out of the total value of the instrument, we need to compute the present value of the financial liability. Okay. And once the value of financial liability is determined from the total value of the instrument, that fair value of the financial liability needs to reduce, which will give us the residual value, and that residual value will be the value of equity. Something which you covered in India's value. So what is this value? Total value of the instrument less fair value, which is present value of financial liability. That is how we measure this. Correct? Now, same principles will apply in case of example number 23 also, because it involves compound financial instruments. So what do? First of all, we measure financial liability component, and from the total value of the component, we reduce the value of this financial liability, which will give the value of equity. Okay? And the way to compute the value of the financial liability will be what? You remember, whenever financial liability was required to be created, what was the measurement mechanism? Fair value of goods received. Why? Because it's a transaction with the vendors, known employees. So whenever transaction was required to take place with known employees, how was the measurement required to take place? Considering the fair value of goods received instead of fair value of the instruments issued, because that is something that we follow in case of employees. Okay, clear? If you have any questions, doubts, please let me know. I'm just hoping you are with me. So I'll pick up some more examples. And one thing which you need to always remember is that it's not a new concept, it's the application of old concepts. So you can say it's a kind of revision for all of you, some of your previous concepts. And please see how easy it becomes if you remember those concepts. Moving further on to example number 24. An entity issues stock options to its employees, which provide an entity to settle. Now remember, when the company is providing stock options to employees, now the company has an option to settle either in cash or through equity. If you look at the past practice of the entity, these stock options have been settled in cash only, and company is also expecting to settle in cash. So that's why what would happen? Now, because company has got two options to settle in equity or cash, is this choice available to the employees? No. So can you tell me that in the given scenario, over to you, in the given scenario, will it be appropriate to consider this instrument as compound financial instrument for the company? Yes or no? And why? I'm waiting for a response. I'm saying that in this example, without looking at the solution which is given, will it be appropriate to call this instrument as compound financial instrument? Yes or no, and why? I'm waiting for a response. If you compare this to example number 22, you will see that in example number 22, we created such type of instrument, but wherein the option was available with the employee as compound financial instrument. Now the only thing which has changed in this example 24 as compared to example number 22 is that the option is not with the employee, option is with the company. Okay, this is the only change. So I'll wait for a response now. Yeah. Quickly, tell me, will it be appropriate to call it as compound financial instrument, and why? Subman is saying, create a liability because payment is made in cash only, which is fine. But can you tell me why it should not be a compound finance instrument, because if you are calling this to be a liability, that means you are saying it should not be a compound finance instrument. But why? What's the reason for this? Vijay Rashmi is saying company will settle whatever is favorable to it. It's not compound finance instrument. So when you say company will settle whatever is favorable to it, then two options are existing. So why you are saying it's not a compound finance instrument? Rather is saying it's not a compound finance instrument as the entity can avoid payment of cash. Very good. Now for an issuer, what do we need to check? That today, whether this issuer has any way through which it can avoid payment of cash in future. Now, in the given case, option is not with the employee. So whatever company will give, employee will have to accept. Secondly, if the company doesn't want to pay cash, can do this. Correct? And if the company doesn't want to pay cash, what would it become? If the company wants to pay both, it would become compound financial instrument. And if the company wants to pay cash, it would become financial liability. Now, depending on the intent of the company as to what do they want to give, this will become compound financial instrument or equity or a financial. Understood? Yeah. So in the given case, because the past history shows they have been paying cash only, that's why we are considering this to be a financial liability. Surishi, Surya, Kalyani, they've all answered the same thing. Very good. So we can now pick up an illustration through which we will also get onto the accounting entries around. Sharika has also answered. She is also saying yes to settle in cash. Okay, great. Same response. Very good. On 1st of January X1, ABC gives options to its KMPs, employees, to take either cash equivalent to 1,000 shares or 1,500 shares. So two options are given to the employees. The minimum service requirement is 2 years. So now, on 1st of January 2000 options are given. And the minimum service requirement is 2 years. 1 year. So, this is the vesting period. And shares must be taken, shares being taken must be kept for 3 years. So, after 2 years, if the shares are taken, they need to be kept for 3 years. So whatever is the time frame, if the shares are taken here, they need to be kept for 3 years. Then we are given information about the fair value of shares. Share alternative fair value with restrictions is 102. Grant date fair value. What is the grant date? This is the grant date. On this date, fair value is 103. Fair value at first year end, and it's the calendar year 120. Then at the end of second year 132. Okay. Employees exercise their cash option at the end of second year. So employees have exercised their right and they have opted for cash after 2 years. You are required to pass journal entries. So before I get on to the solution, Can you all tell me? And again, it's for you, so that's why it's very, very important you don't look at the solution. What type of instrument this will become for the company? Financial liability, equity, or a compound concession. Because so far, on the basis of our discussion, you would have understood that the accounting is completely dependent on the assessment of this instrument. Yeah. So in a way, what are you doing? You are basically revising the concepts of financial instruments. Yes, quickly. What type of instrument this would become? What type of instrument this would become? Okay, Radha is saying this would become compound financial instrument. Alright? What others? So she is saying it should become financial liability. Okay? It'd be great if we just add brief explanation or the reasoning along with this. That will be helpful so that I can also understand the way you have been trying to analyze it. Okay. Question is saying it should be compound financial instrument because the option is with the employer. Very good. So moving on to the solution, if you see in the question it says that the option is with the employer. Whether you offer equity or cash, company doesn't have that option. So what will the company be required to do? If you look at the end of second year, company knows secure. Why? Because everything has gone out in cash. This is what is mentioned in the question. But today, when this option is granted, does the company know whether employee will offer cash or the equity shares? No. So that's why we will not look at the situation of end of second year. That is not known at this point of time. So at this point of time, what will happen? This will be considered to be a compound financial instrument. So the accounting will have to take place as if it's a compound financial instrument. But I would say it should be a compound financial instrument. Sharika also is going with compound financial instrument. But when we say it's a financial liability, and hoping you are understood. Yeah, Vijayashree is also explaining as to how it should be measured. Very good. Sapna, I'm hoping you are clear on this. Yeah? Okay. Now, moving on to the accounting entries. So let's understand how the accounting entries will be passed. So first accounting entry will come at the end of first year, 31st December 2021. And as we discussed that the accounting entries are not going to be any different from what we discussed in case of equity settled and cash settled. So first of all, we book the expense. Employee benefit expense debit. 2. In case it was equity settled, what did we do? We created share-based payment reserve. And in case it was a financial liability, what did we do? We created share-based payment less. It was equity and it was financial. Something we discussed in the last session. Now, when both these components are involved, so what will we do? We will create both of them. We will create both of them. Okay. Now, the only problem that we have is about the measurement. Because earlier, we knew it's a one component, and that's why we measured it as if it's a single component. But now the components are two, so we need to measure this. So how do we measure this? First of all, we need to determine the total amount of the instrument, and from the total amount of the instrument, we need to determine the fair value of liability component. So let's get on to those workings. Correct? Yeah. Okay. So we can say it's a working on one. All right. So now, if you go for equity alternative, what's the option? 1500 shares and having a fair value of 102. It says share alternative fair value with restrictions. It's 102. So equity alternative. So 1500 into 100. So what do we get? 1,53,000. And this computation is being done on 1st of January next month. Okay. Cash alternative. If the company, sorry, if the employees go for cash alternatives, they will get 1,000 shares. They will get 1,000 shares if they go for cash alternative. And for the 1,000 shares which they will get, what's the grant date fair value? We'll have to consider the grant date fair value. 113. So what do we get? 1,13,000. Okay. Now, as regards the equity component which is involved in this, as regards the equity component which is involved in this, what do we do? We just simply say equity component is what? Total value of the instrument is 1,53,000 and the fair value of the liability is 1,15,000. So what's the value of equity component? 40,000. See, the terms which are used may confuse you. You may think, sir, this is the equity component. This is not the equity component. This is the total value. So instead of writing it as equity alternative, you can also write it as, say, total value of the instrument. Yeah, just to avoid confusion. Alright. Now, equity option we have understood this is 40,000. So all of these computations we have done on which date? On 1st of January 2006. But we need to pass this accounting entry on 31st of December 2006. Yeah. Now, what do we understand? We understand that this much is the amount of liability, this much is the amount of equity which needs to go for 2 years. Correct? Yeah. So now what do we need? We need to compute the values for 2 years. So the value for first year and second year, we can compute it now. So this is first December. Now, cash option, that means the cash alternative which is available. Cash option, cumulative amount. Now, the moment we say cash option is involved, it becomes a financial liability, correct? And if it's a financial liability, even though we have measured it on 1st of January 2000 X1, we will have to remeasure it on 31st of December X1. Yeah. So therefore, what we do, we get to see 1000 shares, but at revised value as at the year end. What's that value? 120. And this is the cost we'll book for 2 years. So into half. So what do we get? We get 60,000. Okay. We get 60,000. Alright. Yeah. Similarly, if we move on to the next year, so we will again have 1000 into 132. So this will be 1 lakh. 1,32,000. Okay. Now please understand, this is not the amount of expense. This is the liability. This is the cumulative amount. That's why it's 1,32,000. As far as expense is concerned, what will be the amount of expenses in the second year? This will be total minus this. So we'll get on to that amount also when we move on to the accounting. Next is the equity portion. Equity component. Next is the equity option. Now, in relation to equity option, we have already determined the expense. It's 40,000. So we can say the total amount. Is this equity required to be remeasured the way we have recomputed or remeasured financial liability year on year? No. Equity is not remeasured at every reporting date. So what will happen? 40,000 will remain same for both the years. So here again, if we have to compute the cumulative amount, it will be 40,000 divided by 220,000. And in the next year, to this 20,000 will add another 20,000. This will become 40,000. Please remember, it's cumulative. It's not necessary for you to compute the cumulative amount. If you want, you can also compute year on year. It's up to you completely. Okay. So now, in the first year, what is this amount? This will be 20. This is the amount of expense. Similarly, in the first year, the amount of expense from this liability portion will be 60,000. So this will become 80,000. So in the first year, the amount of expense will be 80,000. Correct? Now, moving on to next year. You can also give the reference of 1. That will be better. Correct? Now moving on to next year. Next year, once again, same set of accounting entries will be passed, but the amounts could be different. So in the next year, in relation to this equity expense, out of 40, 20 is already booked. So what do we book? 20,000. 20,000 will be the expense in the next year. And out of this 1,32,000, 60,000 is already booked. So what do we book? 72,000. So all in all, this will be 92,000. Kalyani is asking, sir, why we are dividing by 2 in year 1? Because this is the total amount. This is the total amount. Okay. And this total amount pertains to 2 years. Remember, in the last session we discussed that whatever which is total amount of expense, I'm saying total amount of expense, that will be recognized over the vesting period. Here the vesting period is 2 years. This plus this. So whatever is the total amount for this plus this, that will be allocated to these two. So that's why this total liability is divided by 2. Yeah. And in the next year, again, if we recompute the total liability, so from the total liability, whatever expense is already booked, that will go off and the remaining amount will go. If you look at this table, this is showing cumulative amounts. Or if you want to see the amount of expenditure, you can also say, instead of cumulative, this will be 1,32,000 less 16,000, which will be 72,000. But in this case, if you are computing this, you should not write cumulative. You should write if you plan to do that. Clear on this? Yeah? Now, at the end of second year, this settlement will also take place. First, now, when the settlement will take place, what will happen? The share-based payment liability that we have, share-based payment liability will get indebted. This liability will go off, and this will be settled in cash. Bank or cash, you can write either. Okay, as far as equity component is concerned, which is sitting in reserves as 40,000, that will remain with equity. By electing to receive cash on settlement, employees forfeited the right to receive equity instruments. Okay. However, the company may transfer the share-based payment reserve within equity, that is, moving it to a free reserve instead of calling it as specific reserve. Okay. Sharika has a query. She is asking, so why we are not comparing cash value with grant fair value and then book the liability, and why this value is divided by 2? So I'll answer your question number 2 first. Dividing by 2 is important because this expense pertains to 2 years. The total liability pertains to 2 years. So out of this total liability, amount pertaining to first year will be booked in first year. Pertaining to second year will be booked in second year. We will not recognize the expense upfront. This is something we discussed in the last session, remember? That's why we are dividing it by 2. Coming back to your query number 1 regarding the valuation. Now, in relation to the valuation, if you see, when it comes to the financial liability, grant date fair value has been concerned. So I consider. How did we compute the liability? Let me just show you again. For computing the financial liability, 1,000 shares are being considered. Why? Because that's the option, that's the fact. and the grant date fair value is 113. This is the amount which has been considered. But the instrument which has been issued does not only have option to pay cash. This instrument has got option to settle in equity also. And if any such instrument is issued which goes with two alternatives, means either to settle in cash or to settle in equity, then fair value of such instrument is different. Obviously, what's the fair value of such type of instrument? Instead of 113, it's 103. And such an instrument will have to go with the shares, because number of shares will have to be considered over here. Yeah, so that's why when it comes to the total value, this is something which will have to be considered. And again, this value of 102 is available on this date only. This is also the granted fair value, but this granted fair value is for which type of instrument, which offers both the things. And this fair value is for which type of instrument, which offers only the option to pay cash. That's why, first of all, we have computed the total amount. From the total amount, we have reduced this. Now understood? Clear on this, Shelter? Vijay is asking, sir, if my grant date falls before any interim reporting period, then we have to recognize for grant date to no. You will have to recognize for the interim period, not for the grant date. Okay. Whatever is your reporting period, it could be a quarter, it could be 6 months, it could be 9 months, or it could be the full year. Yeah. Accounting has to be done for the reporting period. Expenses due for the reporting period. Question is asking, if cash settled, then entry should be made on grant date, and for equity settled on reporting date. No. Entry will be passed on the reporting date only. I think you are getting confused with the last illustration on financial liability, wherein we passed the accounting entry for expense on the grant date. Yeah, that's the confusion. We did that because grant date also happened to be the vesting date. In that illustration, vesting was immediate. Please go back and read the facts. Expense is always recognized over the period. Okay. Shreya is asking, do we need to account changes in fair value on every reporting date? Yes. If it's a financial liability. And that's why I'm saying, for all of these principles which we have applied on these share-based payment arrangements, we need to go back to financial instruments, particularly in days 32. Yeah. If you remember your concepts of financial instruments, definitely this will become very, very easy. But if you would have forgotten those concepts, then the things may become difficult. So that's why your revision is important of financial instruments. And then going back to this topic of share-based payment arrangements along with financial instruments will be helpful. Okay. Vijay is clear on this. Parag is saying, sir, if the employee takes equity share options, then whatever. See, this is known on day one. And it's agreed with the employee that he will only take equity share option. Then of course it will become completely. If you will say that in the given question, employee opted for cash, so that's why we have done away with the financial liability, but instead of cash, let's suppose we opted for equity option. Then this financial liability will go off, and that other equity will also go off, and against which equity shares will be issued. That's the accounting treatment you'll have to do, depending on the type of adjustment it will have. Okay. Clear? Okay, so if you have any questions, any doubts, please let me know. Okay, let's clear on this. Any questions, any doubts, in case you have on this, please let me know. Then we'll move on to the next part of the standard. Okay, Manita is asking, sir, please explain E का B point on page number 5.32. Not sure what did you pick up. So I think you are referring to some old study material, I guess, because I'm not able to get anything on this. Okay, so it's about the understanding of the concept. Okay. So if all of you can refer to page number 5.32, equity settled share-based payment transaction. What is that? In which the entity receives goods or services for its equity instruments, or receives goods or services, but it doesn't have an obligation to pay cash. Very simple. When the entity doesn't have an obligation to pay cash, what should it become? Equity settled. That is something we have discussed. And how will this equity settlement take place? By issuing the equity shares. This second part which Namita has asked me, it doesn't talk about issuance of equity shares. It says that only the cash can be awarded to the bidder. So even if there is a situation in the instrument when the equity shares are not getting issued by the entity, but the entity at the same time doesn't have an obligation to pay cash, even then it will become equity settled share-based payment transaction. And this is something which pertains to the principles of group share-based payment arrangements, which we'll discuss during the later part of today's session. Okay, Namita? Sreya is asking, revaluation surplus needs to be recognized in OCF. Yes. Question is clear on this. Kalyani is asking, in share-based payment reserve created free for dividend, so by whatever name called shareholders do not suffer. Share-based payment reserve is a specified reserve. Okay, on the settlement of the instruments, you can definitely move it to a free reserve, but prior to that, it's not something which is free. It's a specified reserve. Okay, so now moving further on to the vesting conditions. I just go back to this concept wherein we discussed grant date, vesting period. Remember vesting period? Then there was this exercise period. This was the vesting period. This was the vesting date, and so on. Remember this one. Now, in this vesting period, certain conditions were attached, which the counterparty was required to fulfill. Counterparty was employee or the non-employee, means vendor. Now, these type of conditions could be of two types. One is vesting, second is non-vesting. Vesting means something which occurs over the vesting. And the vesting conditions can again be categorized into two parts. So you can just look at this table or flowchart on this page. One type of vesting condition is called as service condition. Service condition means which is based on time. If the condition is that the employee has to stay with the company for 3 years, if the employee has to stay with the company for 3 years, what do we call that type of condition as? Service condition. Service condition. You can also say it's a time condition or condition based on time period. That's it. But it's not always that the condition will require the employee to just be with the company and that's it. No. Condition could also be the one which is based on performance of the employee. Okay. Condition could also be the one which is based on performance of the employee instead of just serving the company over years. So the other type of vesting condition could be the performance condition. Now, performance condition can again be divided into two categories. One, which is market related. Second, which is non-market. What do we mean by non-market? Say if the employee has been given a target that the employee over a period needs to work in such a manner that the profits of the company should move from 5% to say 8% over 3 years. Here, employee is required to perform at a certain level so that this condition is achieved. And this is not something which is related to the market. Let's see how can this be related to the market. Let's suppose employee is given a condition that the share price of the company should increase by say 10% over 3 years. This is again a performance condition, but this performance condition is something which is related to the market. Whereas this profit achievement is something which is internal to the company, that's not linked to the market. So there could be different types of conditions. We need to just assess what type of condition is this, whether it's service condition, whether it's performance condition, means whether it's market performance condition or non-market performance condition. Okay. Now, depending on the type of conditions, depending on the type of conditions, what will happen? Our accounting may change. And for this, I think the best way will be to understand all of these concepts with the help of some examples. But before getting onto those examples, you can just quickly flip through one table which is available on page number 5.58. Though I would always prefer you to get into the solutions, examples first of all. Page number 5.5. There's a table through which you can just flip quickly. Okay, yeah, done. Even if we don't read, don't worry, because anyways, when we'll pick up the example, we'll also discuss all of these concepts. Before this, I can see a couple of queries. Shalika is asking, sir, in the granted, I think Shalika is talking about the illustration number 3. Fair value of the liability was 1,30,000, but at the end of the first year, it became 120 per share. And we calculated 1,20,000 divided by 2, which was not compared both the value and we booked the liability accordingly. Yes, because anyways we were required to book the expense over 2 years. Okay. So let's suppose on day 1 it was 1,30,000, then it moved to 1,20,000, then it moved to 1,30,000. So these were the 3 points. Correct. That is how liability gets changed. Now on this date, no liability was recognized. Obviously, when is this liability required to be recognized? On this date? On this date, what do we book? Let's say out of this liability, 50% should be booked. So that's why we book 60,000 for this. In the next year, if there was no change, we should have booked 60,000, but instead of 60,000, we booked 72 because the liability got changed. From 120, it became 1,32,000. 12,000 was the increase. But can we go back to the first year and increase the amount of expense? No. So that's why it became 72,000 in the second year. Kalyani is asking, so that means, should we write a note in the exam that the company will require this reserve to transfer to field reserve if all the options are settled in cash? Yes, you can write this if required. And if you look at, I think one of the illustrations we saw, there's also a note given. It just go to the note. I did this was illustration number 3 only. If you go back to this illustration number 3, this is note just given after the journal entries. So this is how you can always give the note. Okay. Clear on this? I'm just hoping both of you are clear on this. So we can now move on to illustration number 7. Page number 5.59, illustration number 7. Moving on to this illustration, please. Majorly 60,000 is not compared with 1,30,000 because it was not regular. That's correct. Huh? Okay, let's go on to this illustration number 7, please. All of you. Ankita Holding Inc. grants 100 shares to each of its 500 employees on 1st of January 2000X1. Employees should remain in the service during the vesting period. The shares will vest at the end of the first year if the company's earnings increase by 12%, and they will vest at the end of second year if the company's earnings increase by more than 20% over the 2-year period, and they will vest at the end of the third year if the company's earnings increase by more than 22% over the 3-year period. Okay. So we are given that it's a vesting sort of situation. There are vesting conditions which are attached, and these are not service conditions. These are performance conditions which are not linked to market. But this vesting period is not something which is fixed. After 1 year, vesting will take place. After 2 years, vesting will take place. After 3 years, vesting will take place, depending on the fulfillment of the conditions. Okay. Fair value per share at the grant date is rupees 120. Fair value is 120. In 2000X1, that means in this year. So this is 1st January X1. In 2000X1, it's the calendar year. Earnings increased by 10% and 29 employees left the organization. Actually, what happened? 10% earnings increased and 29 employees left the organization. So this is first year. What was the target? That the earnings should increase by 12%. So that means vesting cannot take place for 1 year. Fine. The company expects at the end of first year that shares will vest at the end of next year. Obviously, they will think that by 31st December 2002, vesting will take place. The company also expects that additional 31 employees will leave the organization in 2000X2, and accordingly 440 employees will receive their shares at the end of 2000X2. So they are saying out of 500, 29 have left and 31 more will leave. 31 more are expected to leave, 440 will be left. However, at the end of this second year, company's earnings increased by 18%. So once again, the condition was 20%, but condition was not achieved. Earnings increased by 18% instead of requirement of 20%. Therefore, shares once again did not vest. Here again, condition was not fulfilled. So we'll have to go back to, go to third year. Only 29 employees left the organization during X2. And here again, instead of expected 31, only 29 employees left. Company believes that additional 23 employees will leave in 2000X3. So here again, they are expecting 23 will leave. So 29 have left in first year, 29 in second year, third year they are expecting it to be 23. and earnings will further increase so that performance target will be achieved in 2000 X3. At the end of year X3, only 21 employees left the organization. So there again, the number of employees who left was different from something which was expected. But now we need to assume that in the third year, company achieved the desired performance level or the target. Means company's earnings increased by 22% over the 3-year period. So this increase has taken place. You are required to determine the expense for each year and also pass the accounting entries in each of these years. Okay. Yeah. So now, what do we need to do? For every year, first of all, we need to ascertain the amount of expense, basis which we will be able to pass the accounting entries. Correct. So we can get on to the computation of expense. So we got 3 years, X1, X2, X3. X1, X2, X3. So if you look at the total employees, those are 500. Out of which, how many left in the first year? 39. So what were we left with? We were left with, at the end of first year, 50 minus 29, and employees expected to leave in the next year is 31. So I'll just incorporate that number also. 31 is expected to leave in the next year. So the number of employees which was expected to be by the end of second year was 440. Then, if we look at the shares per employee, 100 shares have been granted to 1 employee. Shares per employee. This is 100. Fair value on the grant date of the shares. Fair value on the grant date of the shares. This is 122. Grant date fair value 122. And we are expecting see now we are on this date. Please understand that we are on this date when we are computing the expense. Okay, we are not computing this expense on this date. We are computing this expense on this date. At the end of first year, we know the condition is not achieved. Okay. So that's why, what do we think? First of all, the entity will always think that they will achieve the condition in second year. They will not expect at the very beginning this condition to get fulfilled by the end of 3 years. So that's why at the end of first year, what is the vesting period that we consider? 2 years. Correct? This is something which they will expect. So, basis this, what will happen? expense will have to be computed. So what is going to be the amount of expense? 440 is the number of employees. Expected number of employees to stay with the company by the end of 2 years. 440 into how many shares they will get? 100 of fair value of 152. Okay? Divided by. Why? Because this entire expense will be moved over the 2 years. So what does it become? 26 lakhs 84. So by the end of first year, this is the amount which is required to be booked as an expense. Okay. Now, moving on to the second year. Second year, if you look at over here, how many employees have left? 29 plus 29. 58 have left. And 23 more are expected to leave. So what will the balance number of employees? 490. Everyone will get 100 shares of 122. But here again, we understand that the condition is not achieved. Condition is not achieved. So now, can we continue to say that the vesting period will be 2 years? No, because 2 years are already gone. So what is the vesting period? 3 years. Now the vesting period has changed to 3 years. So what's the amount of expense that will go? Number of employees which has changed will require adjustment into 100 into 150. So this is the total amount of expense which should be booked on the basis of revised facts. Correct? But can we book this total expense at the end of second year? No. This should be booked proportionately for 2 years. So we'll say into 2 divided by 3. Yeah. Now this is the amount for 2 years. From this much amount is already booked. Less 26 lakhs 84,000. So what do we get? We get 7 lakh 23,867. 7 lakh 23,867. Correct? We have just revised the facts which were available at the end of second year. Basis which we recomputed the expected amount of expense, and that has been considered at the end of second year. Okay, clear? Yeah. Now, moving on to third year. By third year, we understand how many employees are left. 29 plus 29 plus 21, 73. Sorry, 79. What are the total employees who are going to receive 420? And the 400 shares, 123. And the vesting period, of course, is 3 years. Vesting period, of course, is 3 years. Now, basis this, what do? We will compute the liability. We will compute the liability for 3 years. So I'll have to just clear this part of it. Okay. What is the total expense which will get revised over there? 421 into 100 into 122 into 3 by 3. So this is the total revised expense. Out of this, 26 lakhs 84,000 is already put, and 7 lakh 23,867 is also booked. So what are we left with? 17 lakhs 58,335. So you can also compute this and let me know what is the amount that you have been getting in the 3rd year. You should also compute this on your own. Yeah, all of you clear on this part? Yes, quickly. All of you clear on this part? Now, basis this, what will happen? Accounting entries will have to be passed. Okay, great. Shalita has computed this. Shalita is getting 17,28,333. Great. So I'll just clear this part now. We can move on to the accounting entries. Yeah. Okay, so over to the accounting entry. On 31st December, we'll book share-based payment expense, which is called as employee benefit expense to share-based payment reserve. What's the amount? 26 lakhs 84,000. Fine. Yeah. Next year, same accounting entry will have to be passed. Now the numbers will change. 7,23,867. Then, at the end of 3rd year, for 3rd year, we will again put the expenditure 7,28,333. Fine. Yeah. Okay. Now, 3rd year, equity will also be issued. So, this share-based payment reserve, this total amount will be debited. So, this is 51,36,200. Equity shares will be issued. Equity share capital 51,36,200. Okay, and that is how this accounting should be done. So as you'll see, the accounting concept which we have applied in this illustration hasn't changed, isn't it? In fact, the accounting principles in this entire standard are based on mainly two things. And those two things which we covered in the last session, cash settled or equity settled. All of these concepts that we are going to use now are revolving around those two only. Correct? Just give me 1 minute. Gina, I think you need to check it at your end, please, because I understand audio is all clear. Namita will get on to all of these points. Yeah, let's get done with this. And after we are done with everything, then I'll come on to all of these specific points from your side. Let's just stay focused on what we are doing right now. Yeah, instead of just digressing to all of those concepts, because that may be bothering you. Yeah, Gina, I think audio is all fine. Maybe you need to check it at your end, because we've been experiencing this problem repeatedly. Most likely it's at your end. Okay, so now we can pick up one more illustration number 9. This is page number 5.61. Apple Limited has granted 10,000 share options to one of its directors, for which he must work for next 3 years, and the price of the share should increase by 20% over the next 2 years. So what type of condition we would call this as? This will be market-based performance condition. Correct? Why? Because the share price of the company should increase by 20% over the next 3 years. It's linked to the market. So we are also given the way the increase in the share price over the 3 year. Year 1, it increased by 22%. Next year, it increased by 19%. In the 3rd year, it increased by 25%. So we can say that the condition has not achieved. Correct? At the grant date, fair value of the option was rupees 120 per option. How do we recognize this transaction? So over to you. All of you, without looking into the solution, can you please tell me how would you account for this transaction? First of all, quickly. I'm hoping that you are all clear on this now, and you should be able to answer this. Before I get on to this solution, can you all share your thoughts as to how it should be done? Yes, quickly. Yes. How do you think accounting should be done in this case? Clear? How do you think accounting should be done over here? Okay, Parag has answered this. Parag is saying 10,000 into 120 should be the total amount of expense, and this will be put proportionately over 3 years. Very good. Any more answers? Only Parag has answered this. I think it's very, very simple. Huh? All of you should have been able to answer this. Quickly. You can answer this quickly, please. Should we go to the solution then? Now, in this case, if you look at this 3-year period, so what's the expectation which the company will have? That over this 3 period, conditions will be achieved. So, at the end of first year, what will happen? 10,000 options into what's the option price? 120 divided by 3 will be booked as an expense. Second year again, when these conditions will have to be analyzed. Here again, same amount of expense will have to be booked. Third year again, 10,000 into 120 divided by 3 will be the amount of expense which will have to be booked. Let's suppose by the end of 3 years, this condition is not fulfilled. Then can we just reverse this expenditure? No, because something which has gone to P&L will stay in the P&L. Okay. Obviously, the reserve will get cleared off after 3 years if the conditions are not achieved. If the conditions are achieved, then against these options, shares will be granted, because of which this reserve will move from reserve to equity share. Correct? Kalyani has answered this now, very good. Shalika is saying at the end of first year, company will think vesting period is 3 years accordingly, and in the second year or third year, vesting is done. But after third year, condition is not approved. See, we are not sure whether the third year condition is not approved. As to why you are saying this, because if you look at the paper, it appears that over the period of 3 years, on an average, they have increased by 30%, which was also expected. So that's why by the end of 3 years, what should we do? We need to just move it from reserves to equity share capital, which is also the understanding between the company and the director. Fine? Clear? This was simple and easy to do. So now, we'll move on to the next part, which is about modification or the cancellations which may take place. So now, before we move on to the modification or the cancellation, see, this is the aspect wherein we will discuss how the accounting will be required to be done if any sort of modification takes place in the plan or in the scheme. So let's suppose the scheme was that the conditions are required to be fulfilled over 3 years, basis which shares will be issued. Let's suppose that this period is increased from 3 to 4 in between the scheme or in between the plan. That is called as a modification. What is the accounting treatment which the company will be required to do if the scheme is cancelled? If the stock option arrangement gets cancelled, how that accounting will be required to be done. So these are two aspects that we need to discuss. Okay, so what we can do is we can now take a break. So let's take a break. After the break, we will start with both of these points. In the meantime, if you have any query, you will just let me know. After the break, we'll look at your queries and then we'll just start with modification and cancellation. Okay. But I have also noted down your queries that are slightly related to the topics which are yet to be covered. So once we are done with that, your query should automatically get answered. Okay. So let's take a break now. Ram, Ram, Ram. Hi, welcome back. So we are talking about modification and cancellations. We will get on to its accounting now. I would say quite simple in terms of the way accounting is required to be done. When it comes to the modification means any change in the scheme has taken place. Okay. Now the way this change has to be accounted for, you can say it will be the prospective accounting treatment. Yeah. Instead of getting into too much technicality, I would just say very simply you need to remember that whenever any change will arise, which will lead to a modification, so we need to just consider the change plan from the date of the change becoming effective and doing the accounting prospectively. Say in the example, there was a plan which had a vesting period for say 3 years. Okay. Somewhere over here change has taken place. So now what do we do? On this date we will consider all the modifications, and this modified plan starting from this date up to the date of vesting will be accounted for on the basis of modified conditions. Okay. And no impact will be made in the respective accounting treatment which is already done. So it's the prospective accounting which is required to be followed. Yeah. We can better understand this with the help of an example. So that's why we will move on to illustration number 10. Let's pick up this example to get some more clarity around this principle. Page number 5.65. Illustration 10. Marathon Inc. issued 150 share options to each of its 1,000 employees, subject to service condition of 3 years. Fair value of the option given was calculated at 129. There was a service condition of 3 years. 1, 2, 3. 1,000 employees were given 150 options each, and the fair value of the option was 129. At the end of year 1, 35 employees left. Over here, we had 1,035 left. And further 60 employees are expected to leave. In the second year, 60 are expected to leave. Share options repriced as the fair value fell to ₹50. Now, what is the purpose of coming out with any scheme like this? That the share price is available in the market that's closed at ₹100 and employee can get it at ₹40. So that's an incentive. But fair value of the stock option got declined significantly. That's why share option was repriced. Okay. After the repricing, they are now worth ₹80. Hence, the expense is expected to increase by ₹30. Okay, why we are seeing it's expected to increase by 30? Because fair value is ₹50. Fair value is ₹50 and it's been repriced to ₹80. And the end of year 2, after this revision, 30 employees left. So actually 30 left instead of expected 60, and 36 are expected to leave in the third year. And in the third year, as against this expected 36, 39 employees left the organization. Now you are required to comment as to how this modification should be accounted for. Whether this modification is a repricing which has taken place. So please remember, initially it was rupees 129. Fair value of the option was rupees 129. Okay. So let's understand, when did this repricing take place? At the end of the year. Over here, this repricing has taken place. This the modification has taken place at the end of the year. Okay. Yeah. Now, any change which will arise, whether it's the increase in the expense or decrease in the expense, whatever be the case, that change will have to be accounted for in 2 years. Can we bring that change to first year? No. Okay. Now, if we look at the total increased value due to modification, what do we get? Rupees 30. Total increased value due to modification is rupees 30, which is allocated over 2 years period. So if you look at the total amount of expense and the accounting which is required to be done here on here. So this is, let's suppose here. This is here. This is here. So let's see how the numbers would have been accounted for. So number of employees to start with was 1,000, out of which employees left 25, expected to leave was 16. So employees which remained were 905. Options. How many options were there? 1. And per option value was 129. And what's the period? What's the vesting period? Over here, it's 3 years, but the proportionate accounting will be done for 1 year. Obviously, yeah. So now the expense which would have been booked in the first year will be, you can just compute this amount and let me know, should be 905 into 150 into 129 divided by 3. 905 into 150 into 129 divided by 3. So expense for the first year came out to be 58 lakhs 37,000 250. And this amount of expense would have changed year on year basis the change in the number of employees, considering this to be equity settled. Okay. Now, let's see how things were changed in the second year. The number of employees in the second year was actually the employees which left was 65, 35 and 50, and the number of employees expected to leave is 36. So we get how many employees? 899. How many options are there with the employees? 155. Now, the change which has taken place is about the fair value of the option, correct? Fair value of the option, and that is something we'll have to consider. Fair value of the option initially was 129, and over here the proportionate amount which we should have considered should have been for 2 years minus the expense already booked. So we'll say vesting period was 3 years and proportionately this should have been computed for 2 years less the expense for first year. Now the expense which should have been booked originally, let's see what was the expense which should have been booked originally. 899 into 150 into 129 divided by 3. Into 2, we get 1,15,97,100 minus 58,37,250. So 899 into 150 into 159 into 2 divided by 3 less 58,57,250. So the expense which should have been booked was 57,59,850. But there's a modification which has taken place. Now, because of this modification, what will actually happen? This 899 into 150. This is the number of options. This is the number of options. Okay. And the amount which the company is required to spend additionally is rupees 30 into 30. So this is the additional expenditure, but this will be put over 2 years. Into 1 divided by 2. So what is the amount that they will recognize? 20 lakhs 22,007. Similarly, when we move on to third year, 1,000 was the number, 104 left. So we got 896. I think Shalika has completed this. Very good. I would suggest if all of you can solve this third part now on your own quickly and let me know your answers. 896 is the number of employees. The number of options was 150 and originally this was 129. Here was 2. So the actual expenditure should have been 89. Now I'm not writing this computation, we don't want this. 896 into 150 into 129 into 3 by 3 minus this expense and this expense. Correct? So originally the expense which had been booked was 57 lakhs 40,000 5. So this, what do we need to add? 899 has now changed to 896 into 150 into 30 for 2 years less 20,22,750 which is already booked. So what do we get? 20,09,250. Okay. Yeah. So you can also say this is the original. This is the modification. Okay. Clear on this? Clear on this part as to how the modification will take place? Right? Okay, so just clear this now. Okay, so moving further on to the cancellation. What do we do when the share options or this share-based payment arrangement is cancelled? Okay, I have got few queries. Kalyani is asking, sir, if you can just go back to illustration number 7. Kalyani, what we can do is maybe just hold this query for some time. Towards the end of the session, please pick up this query and illustration number 7. Okay. So this saying, sir, is the amended int AS 102, which is dated 9th of July, applicable? See, for you, whatever you are studying in the study material is applicable. So any sort of modifications which are incorporated only are applicable, otherwise not. Okay. Parag is asking about this addition expense. Addition expense is simply the additional expense which arose to the company due to modification. And over what period you will recognize it? Can you recognize it over 3 years? No. Because when did it arise? It arose in the second year. Or you can say at the end of the first year. So for remaining 2 periods, you will recognize it and not in the first year. Fine. Praveen is asking, sir, why we are considering expected to leave employees in the calculation to find net employees? Because they have not yet left the company, and how the company will come to know at any point of time as to how many employees will leave the company. Only when they resign, then the company will get to know. Then only on the basis of expectations, why are we considering it? I think you are missing out on the discussions that we had in the previous session. Every time when this expenditure has to be booked, company needs to build an expectation about the number of employees who will avail this, because this is an expenditure which we are considering not for current year, but for this entire period, and we are booking that proportionally. So that is the reason why we are considering the expected number of employees and not the actual number. Secondly, how will the company make this expectation? That is something which the company will have to estimate. So it's an estimate. Yeah, definitely estimates are not easy to make, but on the basis of historical pattern, on the basis of expectations, market trends, company will have to analyze this. And companies do this. Okay. So what we can do is, for cancellation, we can move on to this next example on page number 5.66. Illustration number 11. Adara Fertilizers Limited issued 2,000 share options to its 10 directors for an exercise price of ₹100, who were required to stay with the company for the next 3 years. 1, 2, 3 was the condition attached. Fair value of the option was estimated at ₹1. Expected number of directors to vest the option was 8. So it was expected that 2 directors will not remain by the end of the years. During the year number 2, there was a crisis in the company, so somewhere over here. And the management decided to cancel this scheme immediately. It was estimated further as fair value of option at the time of cancellation was 90. Market price of the share at the cancellation date was 99. There was a compensation which was paid to directors, and only 9 directors were currently in employment. Over here, there were 10. Over here, there were 9. At the time of cancellation of the scheme, it was agreed to pay an amount of 95 per option. Okay, initially it was 130, and over here the fair value of the option was 90. So it was agreed to pay 95 per option to each of the directors who were there with the company. How should this cancellation be recorded? I think very simple. We don't need to do any computation for third year because nothing remains in the third year. We only need to do the computation for first and second year. So we compute the amounts for year number 2 and year number 3. So number of directors. 10, sorry. Out of which expected to be 2. So we get 8 as the number of directors. Fair value of the option is 130. How many options have been granted? 2000 options. 2000 options to each director was. So what's the total expense? 2000 into 130 into 8. So let's compute this. 2000 into 130 into 8. So we get 20,80,000. Over a period of 3 years, proportionate expense. $20,80,000 divided by 3. So what do we get? 6,93,330. Okay. Now, moving on to the next year. Here we started with 10, 1 left. So it's something which is actual. So you can say actual or expected. Okay. So actually the number of employees was 9. Fair value of the option during the second year was 130 originally. So I'm just going with the original. And 2000 were the number of options. So the amount of expenditure total would have been 23,40,000. Yeah, and this should have been booked proportionately. This should have been booked proportionately. Yeah. So expense for the year. Let me just compute what should this amount become. This comes out to 33,40,000 minus 16,46,667. 16,46,667. How do we get this? 23,40,000 less 6,96,000. Okay. So now the remaining amount of expense needs to be booked upfront because the scheme is cancelled. But in this case, a cancellation compensation has also been paid. So we need to go to that cancellation of compensation also in the second year. So what's the amount of cancellation compensation? Number of directors. Number of directors is 9. Amount agreed is 95 per option. How many options are there? 2000. 2000. So what's the amount which has been agreed? So compensation amount if you can compute. 9 into 95 into 2000. So this works out to, you can just compute. All of you can also compute and let me know your answers, please. It's easy to do. 9 into 95 into 2000. 17 lakh 10,000. So that's the compensation expense. Alright. Yeah, that's the compensation expense which will be required to be paid. Okay. Now, this is the total amount which is required to be paid to the directors. So that's the settlement at the end of year 2, which is required to be paid to the directors. Amount of compensation is 17 lakh 10,000. Okay. Now, as regards this amount, some amount will have to get adjusted from the equity. Why? Because some portion is sitting in the equity in the form of an expense which was booked in respect of this share compensation expense. Sorry, in respect of share benefit expense. Okay. So let's try to compute what is that amount. Amount which we have in the equity is the one which is equivalent to the fair value of the option on the date when the compensation is paid. On the date when the compensation is paid, fair value of the option was 90. Actually, it's been paid at 95. So, from this amount, deduction from equity should be equivalent to the amount which is equal to the fair value of the option on this date, which is nothing but 9 into 95. Sorry, 9 into 90. This was 90 into 2000. So this, what do we get? 16 lakhs 20,000. So this is the amount which will have to be deducted from equity while making a payment to the directors. Balance amount will go from here. So balance amount will be 90,000, which will go from the PAT. Okay, clear on this? So just to summarize it for your purposes, whenever any such cancellation will happen, so what do we need to do? we need to compute the amount at the fair value and the amount at the actual value which would have taken place. The amount at the fair value should have got adjusted from the equity, because to this extent, reserve is sitting in the books. If you see, we computed reserve in the first year, it came out to 6,93,333. In the second year, again, we computed reserve, it came out to 16,46,667. This much amount is already booked. This much amount is already booked in the P&L, and corresponding to this, reserve is there. So that's why reserve to the extent of this amount will be moved by making this payment to the directors, and any amount over and above this will go to the P&L fund. Okay. Clear on this part? Alright, so if you have any questions, any doubts around this, please let me know. Then we'll move on to the next part after this. Yes. Waiting for your queries if you have. Yes, any questions in case you have in this? Okay, Vijayashri has completed this. I think Vijayashri has shared an answer. Sharika is asking, sir, can you please explain again the last point of deduction from equity? Sure. See, if you look at the equity, couple of amounts have already moved to that. 6,93,000 plus 16,46,000. 667. These two amounts have gone to equity. Okay. Now, just because this plan is cancelled at the end of the year, we cannot say we'll reverse, because something which has already been approved will continue to hit the P&L. Yeah. So this much part has already hit the P&L and has gone to the reserves. Just to answer the question, Kalan. Now the next question arises is about the payout. Even though this much amount has hit the P&L, the actual payout is this. Okay. Now, as against this actual payout, if you compare this to the actual expense which is already booked, what do we see? We see that an amount, now what is this 90,000? 90,000 is an amount pertaining to rupees 5 per option. This is in respect of rupees 5 per option. Rupees 5 per option has been given to each director as a compensation expense. Why? Because fair value was 90, but still the directors were given 95. Yeah. So this amount, in simple terms, we can say any amount over and above fair value at the time of cancellation, which will be paid to the employees or which will be paid to the counterparty, should hit the P&L. This should hit the P&L. So that's why 90,000 will hit the P&L. We can also compute this 90,000 straight away. How? 5 into 9 into 2,000. We'll get the same number. We'll get the same number. Yeah. What about this remaining amount? So 90,000 will go from the P&L. The balance amount out of this total payout will get adjusted from this reserve. Clear on this? Shelika, Pelani, I'm hoping all of you are clear on this now. Quickly, all of you clear on this now? Yeah? Clear on this? So with this, we can move on to the next part of this standard. I would say an interesting part. And hopefully that should also answer some of your queries, like the ones which Navita has been asking about the explanation on some part of the definitions. All of those queries will now get resolved because this is the part on which same concept will be applied, which we have discussed in respect of cash settled and equity settled, but which widens the horizon of the share-based payment arrangement. And for you to understand group share-based payment arrangement, once again, it will be very, very important to remember the principles of financial instruments, debt versus equity. Okay, yeah. All of you, if you can refer to page number 5.71, please. Page number 5.71. Okay, if all of you can go to this page, there's a flow chart with the help of which we will try to understand this concept. You all can go to this flow chart, please. Yeah. Okay, so let's try to understand what do we mean by group share-based payment. So far, every time when we discussed about share-based payment arrangement, we have two parties, company or you can say employee. It can also be a non-employee, but for our discussion, I'm just taking an employee. Every time company was receiving services from the employee and giving options to the employee in return, whether those were equity settled or cash. Okay. And I need your attention, and I need you to please follow me very, very carefully because this is a very, very simple and interesting concept. But if you don't understand this, then this will become very, very difficult. So I'm just repeating the point. Every time in this arrangement, company was receiving the services. company was receiving the services. In this arrangement, every time company was receiving the services. And every time in this arrangement, the company which was receiving the services was also doing the settlement. This settlement was also done by the company receiving the services. No third party was involved. Okay. This settlement was possible in two ways, either cash or equity. So this is just to summarize whatever we have discussed with. Correct? Yeah? Okay. Now, what I am doing over here is I am replacing this company with its holding company. And I am making this company as a subsidiary company. So I'm saying now instead of one company, I am bringing in a group. Group which is comprising of holding and subsidiary. Okay. And now the way I will consider it will be slightly different. Why? Because if I look at the standalone financial statements, you all understand standalone financial statements? This company will prepare its standalone financial statements, this company will also prepare its standalone financial statements. The way company will prepare their standalone financial statements, understanding may be different, and the way company will prepare its consolidated financial statements. See, because if these are holding and subsidiary, they will prepare consolidated financial statements. Okay. So now let's try to understand. Say there was an employee X. He was working with holding company and he was given a scheme that he should stay with the company for 3 years, or certain benchmarking was given, some condition was attached, after which he will receive the shares of holding company. Okay. There was some internal restructuring in the group. Obviously, it's a group. This employee was moved from holding company to subsidiary. Yeah. Now, who is receiving the services of this employee? This X, this employee, who is receiving its services? Services are received by this company. Subsidiary company is receiving the services of this employee now. Why? Because this employee has been moved from holding to subsidiary. But that scheme still continues. That scheme has not been cancelled. Still the arrangement is that after completion of 3 years or after achieving certain parameter, employee will get the shares of holding company. Now, he will not receive the shares of subsidiary company. He will get the shares of holding company. So, the original scheme continues. So, now, there is a problem. There is one company who is receiving the services and there is other company who will do the settlement. settlement will not be done by this company. Settlement will be done by other company. Understood? Yeah. Now what do we do? We have not discussed any such situation so far. So what do we do now? How do we need to do this accounting? Whether we need to do this accounting at all or not? How will holding company record this transaction? Because they are not receiving any services of the employee. How will subsidiary company record this transaction? Because they are receiving services of the employee but free of cost. Holding will have to pay a cost for the services which it is not receiving. And subsidiary is receiving the services for which nothing will be required to be paid by subsidiary. Yeah. So we have this very peculiar situation. And let's also try to understand, if you look at the group picture means if we look at these two companies together, if you look at the position of these two companies form one group. These two companies form one group. We have discussed about the problems which standalone financial statements of this company will face, standalone financial statements of this company will face. But if you look at the consolidated financial statements, what is happening right now? Employee is providing services to the group. Means group is receiving the services and group will be required to settle. Because group is what? These two on a combined basis is one group. So there it's no problem. So if you look at consolidated financial statements, the perspective has completely changed. Yes or no? Now, such type of arrangements, wherein instead of a company, group is involved and employee is engaged with the group in these type of situations, where he is providing services to one and settlement will be done by other, is called as group share-based payment arrangement. Okay. Clear? Now, as around its accounting, as to how its accounting is required to be done, we need to look at this flow chart. Let's try to follow this flow chart, through which we will try to understand how this accounting will be done. Yeah? So we are starting by looking at the counterpart. Who is the counterparty? Employee X. So instead of counterparty in this flowchart, I use the term employee. Fine. Does the employee get my equity instruments? Who is my? Let's suppose we are looking at it from this company's perspective. Okay, we are looking at it from this company's perspective. Does the employee get equity instruments of subsidiary? If yes, why are we saying if yes? Let's suppose this employee is engaged with subsidiary. This employee is engaged with subsidiary, employee is rendering services to subsidiary, and this subsidiary itself will do the settlement. This subsidiary itself will do the settlement. Okay. And how will the settlement take place? By issuing equity shares of its own. Then, what type of instrument that will become? Looking at it from this company's perspective, equity set. Correct. Will this company be required to do any accounting over here? No. Okay. Let's suppose if we say, does the employee get equity instruments of Subsidiary company, if we say no. Employee is rendering services to subsidiary. Okay. But subsidiary will do the settlement, but subsidiary will not issue its own shares to the employee. How will the employee get settled? Employee will get equity instruments of another entity in the same group. If we say yes, if we say this employee will get equity shares of holding company. Okay, so you can go to this condition, yes. Then we need to check, do I have to provide those instruments? Means, am I the settler? Who is I? Subsidiary. Now, I am repeating this one. Employee is rendering services to subsidiary. And who will do the settlement? Subsidiary. Subsidiary is required to issue shares to the employee. Shares will not be those of subsidiary company, but those shares will be of holding company. So what will subsidiary do? First of all, subsidiary will buy the shares of holding company and then issue those shares to the employee. Correct? In such a case, what will happen? For a subsidiary, that will become cash settled. Why? Because subsidiary will have to buy the shares of holding company and then give to them. So that will become cash settled. Okay. If we say that the subsidiary will not be required to provide those shares to employee, then what will happen? Subsidiary doesn't have an obligation to pay cash. The moment we say subsidiary doesn't have an obligation to cash, still the subsidiary is receiving the services. See, the subsidiary is receiving the services, but subsidiary is not required to give the shares to the employee. Who will do this settlement? Holding. In such a case, what will subsidiary do? Subsidiary will record it as equity. Why? Because it's an equity contribution from the parent. Yeah. Namita, if you go back to your query, this was your query. Remember? Yeah. So now the subsidiary is receiving the services from the employee, but is not required to settle. Who will settle? Holding. Holding will settle on behalf of subsidiary. So subsidiary has received non-cash benefit from the holding. How do you record that? If you go back to the principles of financial instrument as equity, as other equity. So that's why if we say, do I have to provide those instruments? Am I the settler? No. The moment we say it's no, what does it become? Equity settled. Okay? Clear? Okay. So now we'll move on to the other part of the flowchart. Does the employee get equity instruments of another entity in the same group? If we say no, then we need to check, does the employee get cash based on the value of either equity shares of subsidiary or equity shares of holding? If we say no, employee will neither get equity nor get cash. So is that covered within Ind AS 102? No. But if we say yes, employee will not get equity shares, but he will get cash. And cash will be based on equity shares of subsidiary or holding. Then once again, what we need to check? Who will settle this? If subsidiary will have to settle this, what will happen? This will become cash settle. The subsidiary will have to pay cash. If subsidiary will not be required to settle, employee will get cash, but subsidiary will not settle. Subsidiary will only receive services. So how will subsidiary record this? Subsidiary will say this cash is being paid by a holding. So holding has provided a non-cash benefit to the subsidiary. Why? Because the cash which was required to be paid by subsidiary is being paid by holding to the employee. Okay. So how will the subsidiary record it as? Equity. Equity. Correct? Clear on this? If you have any questions, any doubts on any of these points that we have discussed, please let me know. Quickly. Any questions, any doubts which you may have on this, please let me know quickly. After this, we'll move on to one example. Because with the help of this example, I'm hoping you should be getting more clarity. Yes, I'm waiting for your query. Okay, any questions, any doubts? Okay, Vijaya Rashi Singh said not clear on the equity settled type of arrangement. Okay, no problem. So what we should do is, I think we should pick up this example. I'm just hoping with the help of this example, we will get more clarity. And what we can do is, after discussing this example, we can come back to this flow chart. Yeah. Okay, so if we can move on to illustration number 12. A parent grants 200 share options to each of 100 employees of its subsidiary. We have this parent, subsidiary, and the employees. Employees of subsidiary. Who is granting the options? It's the parent. 200 share options, 200 options. 200 options. Okay. This is conditional upon completion of 2 years service with the subsidiary. Fair value of the share options. Grant date is ₹30 each. Just a minute. Fair value of the option on the grant date is ₹30 each. At the grant date, subsidiary estimates that 80% of the employees will complete the 2 years service period. 80% are expected to complete this. And 100 options have been granted at the rate is 30 each. Estimate does not change during the vesting period. At the end of the vesting period, means after 2 years, 81 employees complete the required 2 years of service. So expectation was 80, but it actually changed to 81. So actually there were 81 employees instead of 80 at the end of 2 years. The parent does not require subsidiary to pay for the shares needed to settle the grant of share options. Now, let's try to understand the situation. Who has been receiving the services? Can you all quickly tell me? Over to you, please, quickly. You need to be very, very quick now. Who is receiving the services over here? Quickly. All of you. I want the answer from you. Quickly. It's very, very simple and interesting, as I told you. Who is receiving the services over here? All these services are being received by whom? Who is receiving the services? Quickly. Yes, I'm waiting for response. If you'll answer some of these simple questions which I have been asking you, you will immediately get the solution. Okay. So tell me who is receiving the services. Vijay is saying subsidiary is receiving the services. So ideally, who should pay for this? Subsidiary. But parent doesn't want subsidiary to pay. So actually what has happened? Let's try to understand. Employees have rendered service worth of, so what's the worth? 200 options into rupees 30 into expected number of employees 100 and 100 into 80. Okay, so this is, what's the amount that we get? 4,80,000. Employees are rendering services which is expected to be worth of 4,80,000. What's the worth of this expense? 4,80,000. Ideally, subsidiary should pay for this equivalent to 4,80,000. Either it can pay in cash or through its own equity shares or through equity shares of its holding company. But who should pay for this? Subsidiary. But is the subsidiary required to pay this? No. No. So in the first year, when 50% of the expenditure will be booked, so this will be 2,40,000. In the first year, when the expense will be worth of 2,40,000 for subsidiary. So what do we call it as? Employee benefit expense, which the subsidiary should book in its books. 2,40,000, and you will be thinking, sir, why to book this expense? Because subsidiary is not required to pay for this. Still, it will be required to book this expense. And corresponding to this expense, what will subsidiary say? Subsidiary will say it's a capital contribution. Something which you would have covered under financial instrument. This 2,40,000 is a benefit which holding has paid to the subsidiary and for which holding has not charged anything from the subsidiary. Holding is not asking the subsidiary to pay for it later on. No, holding is saying, don't worry, I will pay this to the employees on your behalf. So this is free of cost for you. So it's a non-cash benefit which the subsidiary has received from the employee. So if there is any non-cash benefit which subsidiary receives from the parent, what does it, what would the subsidiary call it as? Other equity or capital contribution. Or you can say capital contribution. And this is something which you would have covered in the financial instruments, correct? So therefore, In this situation, for subsidiaries books, what would you call this type of accounting as? Equity settled. Because when it was equity settled, this is the accounting treatment you were doing. Yeah? Now clear on this. What is equity settled? Vijay, Rashmi, you are clear on this. Namita, I am hoping you are clear on this. Everyone clear on this. Yeah? Clear? Okay. Now similarly, what will happen next year? So this is year 1 end. Similarly, next year, year 2 end, when it will come. This expense will change. How will it change? Because now the number of employees have increased. So 200 into 81 into 30. This is the total amount less 2,40,000, which is equivalent to 2,46,000. Next year, it will book this expense, and next year again, it will book this much amount as equity contribution, capital contribution. Clear? All of you? Everyone? Now you understood? Yeah? So you can say, how is this required to be settled? Through parent. Is subsidiary required to pay anything over here? No. Still the subsidiary will have to record this. Why? Because it's been receiving goods or services. So it will have to book this expense. This is something which you used to call as, this notional accounting. Something which existed under financial instruments also. These are the same principles which have been drawn over here. And that's why I told you, in this entire standard, if there are two concepts, if you understand those two concepts properly, cash settled and equity settled, you are done. Remaining all concepts in the standard are drawn either from financial instruments or are drawn on the basis of that equity settled arrangement or cash settled arrangement. There's nothing which is changing in this standard basis. Clear? All of you? Yeah? Vijay is now clear on this. Very good. So now what I am doing is, I am now taking you back to this flowchart. I am now going back again to page number 5.7. And we'll revisit this flowchart. Because this flowchart completely explains group share-based payment arrangement. So that's why at the time of exam, you should make sure that by going through this flowchart, only through this flowchart, you are able to revise this. If you are in such a situation, you should assume that you are prepared. Otherwise, you are not. Okay. So I'm taking you back to this flowchart. Does the employee get my equity instruments? If we say yes, it's equity settled, of course. If we say no, then we need to check, does the employee get equity instruments of parent? If we say yes, then I need to check, do I need to provide those instruments to the employee? If we say yes, then I have to buy and give to the employees. It will be cash settled. If we say no, the current situation that we had, it will be equity settled because I don't have to pay for this. They will settle this on my behalf. Okay. I'm moving on to the next part. Does the counterparty, does the employee get cash instead of equity shares based on equity shares of S or P? If we say no, then employees are neither getting equity shares nor getting cash. Can it get covered under India's 102? No. Because for any benefit to get covered under India's 102, it has to be based on the shares price of the entity, which is not the case. So that's why we move out of this standard. Other part. If we say yes, employees will get cash. There again, subsidiary will check who will pay the cash, who will settle this obligation. If the subsidiary will be required to pay cash, what is it? Cash settled. If we say no, subsidiary will not be required to pay, parent will pay, then there again, what is it? It's a non-cash benefit flowing from the parent to the subsidiary. Correct? So there again, it will be equity settled. Now everyone clear on all of these principles. I can see this query coming from Kalyani. Kalyani is asking, sir, will the holding company pass entry only in the year of issue as follows? Investment in subsidiary to equity. See, when the holding company will pass this accounting entry, this will again be the mirror end. Whenever subsidiary will pass, holding will pass. It has to be mirror end. So subsidiary will pass capital contribution. Yes. So this capital contribution will be deemed investment for the holding. So holding will say deemed investment. And obviously against this deemed investment, they will eventually issue the equity shares. Clear? Clear on this? Yeah. So with this, we come to an end to our discussion, and as regards the gap differences which I told you, this standard is full of gap differences because under Indian gap we don't have any accounting standard as such. It's only a guidance note, and as we discussed that for the purposes of your references, you need to look at the one which is the old one because that is something which has been discussed over here. So that's why there are a lot of gap differences. Yeah. And now, before I conclude on this part, a couple of very important points for all of you. One, see, we have discussed all the concepts and we have also tried to solve as much illustrations, examples as possible so that you get the concept clarity. But still, it's very, very important that you practice the questions on your own. There are some questions we have not practiced and some we have practiced. So it doesn't matter that you are practicing the same questions which we have practiced in the class. It doesn't matter. When you will solve the questions which we have solved in the class on your own, maybe you are not able to do that. So that's why it's important that you start practicing all the questions and not the ones which are left out in the class. Okay, number one. Number two, for the purposes of your revision in the exam, make sure you are having summaries because you will not be able to read entire stuff. You will of course get the presentations which will have this content. But if you want, you can always have your summaries which are drafted by you, in your language, and which could be tailor-made according to you. So these two are very, very important things for the purposes of the examination. Yeah, clear? So with this, we can just end our discussion over here. And if there is anything as regards your queries, etc., I have missed out on that, just feel free to send your queries and we'll be able to answer those queries. And still, if there are any queries that we can discuss now, I'm happy to have a discussion on those queries. Right? Okay, so I'll wait for your queries, if any. Okay. Any questions? Any doubts? No. All right. So with this, then we can just conclude our discussion. Yeah. So thanks to all of you once again for your time. I don't see any queries coming up. Maybe if you still have got any queries, don't worry. Just send across your queries and we'll just try to resolve those queries for you. All right. Yeah. So thanks to all of you once again for your time, for your wonderful participation. Thanks so much.